Good. Well, I am very delighted to be here in this very hot presentation. Is going to be dealing with something that John and I were talking about earlier, which is called the rhythm of sevens. And this is essentially what John was saying. Every 7 years or so, the theory goes that the stock market crashes, right? So when you look at it, you know, there's evidence that some people kind of purport on radio. You know, they give you all of these different dates and the crashes that occur. But basically, the premise is every 7 years, there's a big market correction. So let's take a look at this evidence to see if this is really the case. So we're going to start off with the first big one, 1987. How many of you were investing back then? Quite a few of you. You remember it, right? It was the scariest, quickest, fastest sell-off we saw up until that point. And in fact, you know, if you kind of look back to some of the interviews with some of the traders, the Federal Reserve, people basically thought the U.S. financial system was going to collapse. It was about 12 hours away from collapse at that point in time. This was very scary. And I know that my mother went out and because my dad had put everything in mutual funds back in the day, he lost so much money that she went out and purchased a king-size bed set. She said, at least I know where my money's going to go if it's going to disappear. So it really left, I think, a big psychological imprint on everybody is how quick and fast you could lose money in the stock market. Let's go forward 7 years, 1994, there's a quick 10% sell-off in 1994. 2001, the tech bubble popped. Anything that had a .com next to it just went up in flames and just burned out. 2008, the financial crisis, all the mortgage-backed loans, Alt-A type mortgage loans, all went up in smoke, and that basically caused a cascading effect of the financial crash. So here we are 7 years later, in 2015. And the big question mark that everybody's got is, well, what does that mean in terms of a big market crash? When you look at the data, how many people would say that there is something to be said about this rhythm of sevens? How many of you would say that there is some kind of a pattern? Yeah. Okay, fair enough, right? So the thing that I always ask people to do is in this situation, when we discover something that looks to be somewhat of a pattern or looks to be somewhat of a correlation, we have to ask ourselves, okay, are we starting with a preconceived notion and fitting data to prove our preconceived notion, or are we truly just looking at all the data and coming to some conclusion at the end? And so the thing we have to ask ourselves is, are our short-sighted observations leading us to faulty conclusions? Now I'm going to stop and pause and explain this illustration. I love this because it really talks a lot about how sometimes we can make very short-sighted observations. This actually comes out of a 200-year-old poem out of India. And the premise of the poem was there were 6 blind men in India. They had never heard, felt, seen, smelt an elephant. And so what happened is there was a circus that came through their town in India, and all 6 of them said, well, hey, let's go check out this elephant. So they all went to the elephant, and all of them happened upon a different part of the elephant, and one gentleman happened on the tail. And he says, I finally know what an elephant is. It's like a rope. Feel how long and strand-like it is. Another gentleman happened upon the leg. He said, no, it's not a rope. The elephant is like a tree. Feel how round, broad, and sturdy it is. And the third gentleman happened upon the tusk. He says, well, it's not a rope. It's not a tree. The elephant is a spear. Feel how sharp and pointy it is. Now, each one of these gentlemen was right in a very small sense of the term elephant, but when you look at the whole elephant, they were completely wrong. And this is something that we have to protect against when we look at data. Are we looking at just a small bit of data or enough data to see the big picture? So when we actually take a step back and we look at this rhythm of sevens, what we find is that right in between 1994 and 2001, there was a big sell-off in 1998. There was an Asian financial crisis. It started with the Thai currency, the Thai baht, that translated over to Korea, translated over to Japan, and came over to the US and impacted our markets. And then actually the 2001 date that a lot of people use for the rhythm of sevens started a whole year earlier. In 2000, March 2000 is when the tech bubble finally popped. And after 2008, there was a flash crash. Do you guys remember that in 2010? Dow Jones was off 1,000 points in just 15 minutes. That led to a bigger correction of 15%. How about in 2011? Standard & Poor's downgraded the U.S. debt outlook. That led to a 20% correction in our markets. 2012, the Congress that we love was at a stalemate, approaching a fiscal cliff and a budget deficit. Markets sold off in anticipation of that. And most recently in 2014, just this past October, we had a 10% sell-off as fears of how quantitative easing would impact the markets, right? The Fed bond buying program. So when we look at this data in this context, how many of you think that the rhythm of 7 still holds? This...
I think it does.
Sure, go ahead.
No, it all depends upon the people that have a lot of investments, not us. We maybe 1%. And they decide when they think something's going to happen, and they're the ones sell off.
Sure.
And so the big guy sells off because he knows something's going to happen for a correction. Has to correct. Just can't keep going up, right?
It's interesting. The funny thing is, when we look at markets, nobody knows what's actually going to happen. So the big concern is that the big guys know something that we don't. The matter of fact is that all of the big players in the world are playing against each other, all together. So it's kind of like if you were at World Series poker tournament and you get down to the final table and there's 10 players at the table. Well, you've got Goldman Sachs on one end, you've got JP Morgan on the other, you've got Morgan Stanley, you've got Bank of America, and all these players are basically trying to outmaneuver each other. So it really holds true that no matter how big you are as an institution, no matter how much money you can control, nobody really knows what the future is going to hold, and they're all just trying to read each other and trying to see what each other is doing at any given point in time. But we can talk about that later. Keep your question. We can actually do that towards the end of the presentation. But I think most people would see that whether the correction ranges from 10% to 50% or more, really the 7-year rhythm to it maybe isn't predicated on a time continuum, but it's something else. Maybe it's jobs, employment, GDP, CPI, whatever it is. It's not this 7-year cycle that a lot of people are using as fear tactics. Yes, question?
Yeah, like the different countries overseas too. They keep talking about Greece, how they might default and things like that.
It could be, yeah. It absolutely could be. And one of the funny things is in the 1980s, or actually early 1990s, if you remember, the Philippines was in almost the exact same spot that Greece was in. Now, they don't have their own they don't have a unified currency the way that, Greece does. But we actually went through a huge stock market rally during the 93, 94, even though the Philippines was defaulting. So it's hard to know what any one event is going to do to the market. And I think that's why this talk is very important, because when we start to try to predict or forecast what might happen, what tends to happen is now we're operating out of fear, right? Or we're operating out of greed. If we don't have a strategy, and all we're doing is we're looking at a very small set of data, what can happen is that can influence our emotions. And what happens is when we make emotional decisions, many times they're not the logical or correct ones to do at a time. And that actually plays into the larger scope of investing. When we look at how this applies to us, looking at data, it's not just the data we're looking at, we need to know the context, right? And that's why when we look at more data, it gives us better context with which to interpret the little bit of information that we're looking at. So I wanted to do a little test here and see what everybody would think about two different strategies. One is a very simple buy and hold index strategy. You just buy and hold the S&P 500, kind of like the Vanguard fund, low expense ratios. You just buy it and hold it until forever, right?
And Matthew,
sure.
Speak to them as you're the advisor. Have them tell you what they want you to do and why.
Sure.
But you really engage yourselves as part of it. It's very important.
And the other one that I'm going to pitch to you, since I'm your advisor, is, we've got this really great strategy. In the past, it's performed very well. It's outperformed the S&P by a wide margin. Right now it's not doing too well, but we're confident that in the long run it's going to do well. How many people, based on this performance over the last 9 months, thinks that strategy A is better than a buy and hold, keep it simple, low expense strategy of the S&P 500? How many people think strategy A is better? Okay, how many people think the low expense way to go is better with the S&P 500? It's up 20%, it's up more. You don't have, that's not all the hands in the room, come on. I saw like 7 hands for strategy A and 1 hand for strategy B.
Let's see this. Let me see this. Let's rephrase this, okay? Strategy A costs you money. Costs you 2.5% a year. Strategy S&P costs you nothing. And how many of you really think you don't want to get, how many want to go with S&P 500? You all do. Raise your hand. You all do. And you know why? There's no criticism. I know why. It's the thing you can understand. That's why we want to help you understand more. Right?
All right, let's look at a 14 months later. Okay, strategy A is now up 55% over a 1.5-year time frame. S&P is up 43%. How many people like strategy A now? Even though you're paying a fee for it?
Now, how many of you that chose the S&P now want to go to strategy A? So now we're looking at 14 months later saying, look, I told you, strategy A I thought was a better way. How many want to go to strategy A now? You're going to leave the nothing, go to A, right?
So we're going to fast forward 3 more months. Strategy A has a very wicked pullback. They're neck and neck. Who wants strategy A now?
Still?
You're paying a fee for this advice, okay? Don't put those hands up. I know better than that.
So most of the room is still with strategy A, or now are we back in the S&P 500 camp? Who's in S&P 500? Slow and steady wins the race. Keep the fees low. Okay. Who likes strategy A still?
And
Okay.
Because I'm paying somebody to look at that,
Okay.
all right? And they're supposed to be looking at the total, they're supposed to be smarter than I am,
Right.
and they're looking at the total picture, where I'm not.
He's a smart man. Look at this over a 24-month period. Strategy A is up 154%, and the S&P is up 67%. So in this scenario, was that expense ratio or the management fee worth it to get that much outperformance over a 2-year period?
You're doing right.
Okay. How many people who were S&P 500 buy and holders, benchmarkers, how many of you would maybe think, you know what, strategy A really is good. This is a 2-year period, and it's doubled the performance of the S&P 500. How many people would want to switch over and buy the strategy A? Right? I mean, that's pretty large. That's a big margin. Okay? So that's what our gut is telling us, is all of a sudden we have the benchmark going one way, and we have a different strategy way outperforming it. What emotion are we invoking? Greed. So we just made the decision to switch over to strategy A using greed. The only thing we based our decision on was performance, right? So we buy it. 9 months later, how many of us are kicking ourselves? God, I knew it! Right? Anything to add to this one, John, or fast forward? 20 months later, almost 2 years later, the buy and holders made 22%, and this strategy A is 43% down, negative. That means you're underperforming your neighbor who maybe is just a buy and holder by almost 65% differential. How many of you are thinking, yeah, I'm firing this guy. I'm not paying a management fee to underperform by 65%. At this point in time, over 20 months, how many people are going back to the S&P 500? Let's be honest. Come on, come on. How many of us are S&P 500 now, right? Okay.
Follow my man.
Al has been a client for many years. he didn't start out this way. I guarantee you.
Let me ask everybody, if we are losing money relative to people around us, and we choose to take action on that, what emotion are we now operating out of? Fear. Exactly. So we go here and we say, we are in a fearful state, and we are going to switch it now because we don't want to underperform and keep underperforming, and much less pay somebody for us to underperform. We can all underperform just fine by ourselves without paying a fee, right? So here we sell it, okay? So we're going to sell it right down here at the bottom, and 3 years later, not that bad, right? S&P 500's up 9%, Strategy A is still down 11% for that time interval. It's not the best decision, but it's not the worst decision. How many people still think S&P 500 is the way to go? Keep the fees low, right? Okay. So here's where it starts to get a little interesting is 8 years later, do you think that Strategy A is all that much better than the S&P 500? 8 years later, you paid somebody, a lot of money, fees, and it's 17% total return versus the S&P, which is at 12. Who would have just rather kept it simple, not have to go through all that under or over performance? If you just go with the benchmark, that's what everybody gets. Doesn't the S&P 500 look pretty good at this point? Question?
Is Strategy A an actual?
It is an actual. It is actual. No, it's
Not theoretical.
not theoretical. It's actual. We'll get to that in just a second. So now,
What's happening here, though, is that the only thing we can evaluate is what our return is at that moment in time and what our cost is. That's all we have to base it on. Nothing else. And if you think about that, how could I make a good decision if that's all I do? That's all most people know. These cycles, when we invest in a portfolio, you've got probably a 7 to 12-year cycle to get through the market.
yep. And for those of you who thought the S&P 500 was the better way to go, buy and hold, index it, could I convince you by saying that Strategy A invests in the most valuable stocks, the earnings are good, but the price is down? Would that convince any of you? What if I told you invested in stocks that paid good dividends, had good products? No convincers?
And Strategy A, they're kind of, they're solid companies, good earnings, good PE ratios, not really exciting companies, but they're highly profitable, pay good dividends.
No takers, huh? So we're going to fast forward 17 years later, after we sold. Strategy A is up 172%. S&P 500 is up 87%. Which one is clearly the better one over a long time frame? What's most important is, we'll get to what Strategy A is and how that's determined. But what I want everybody to take away from this presentation is how many times our emotions flip-flopped from fear to greed to fear to greed. And all we were doing was basing our decision to switch from one to the other based on one data point, which is performance, relative performance to a benchmark. Now remember, we talked earlier about how if we only look at a very small bit of data, it may lead us to a conclusion that is actually not the case if we looked at more data. So my question to everybody is, do you know what this strategy is, the Strategy A? It's high dividend paying, value stocks, low PE ratio, high cash flow per share.
Buy and hold.
Buy and hold. Anybody have an idea of what this strategy is?
Looking at that graph.
I'm hoping for, and I believe this today, is that that strategy could be a group of people who I have determined to deal with my money so that I never get fearful
Sure.
and I never get greedy.
Sure.
It's left up.
You want to keep the emotions right in the middle, right in the middle.
And then I'm at peace, and I know that, things are going to come out well, because I
Right.
believe he's not going to sell at low. I believe he's smart enough to sell if he has to sell at high.
Yeah.
So therefore, I can't.
I agree.
I'm never greedy or I'm never fearful. I'm not.
Yep. I agree with everything you just
The
said.
challenge is you can't invest at the end of the game.
Yes.
You can't- Some games that are going to do it. You have to do it ahead of time. But you have to have a, you know, we're all going to gamble $1,000 this weekend on a ball game. And we got a choice. It's a football game. We either bet on the varsity team or the JV team. The JV is playing the varsity. Who's going to bet on the JV team?
Obama.
But why would you not bet on the JV team?
Less experience.
Less experience, not as big, not as strong. So let's say we bet this weekend and the JV team wins. Next weekend we have another game to bet on. The JV or the varsity. You bet on the JV or the varsity? Varsity, right?
Still the varsity.
So the JV team can win occasionally, but the varsity team, because the fundamentals are going to win out more times than not.
Yep.
It's not Warren Buffett into that.
Could I,
Depending on what you know about the two teams.
Well, 12th grade and 9th grade.
you had a question?
There's another factor in your last graph
Sure.
that we as clients are more concerned with than you as brokers. That 17-year span is coming quicker for us
Yep.
than it is for you.
Absolutely. Absolutely.
Will we be here those 17 years?
Absolutely. Let me ask you this. Would I help anybody in explaining strategy A if I said he was a market expert? Would that help anybody? He's been on CNBC. Does it help anybody with the strategy, naming the strategy?
It depends who voted him on market expert.
Strategy A is Berkshire Hathaway stock over the last 17 years. Now, when I say Warren Buffett, what are some of the words that come to your mind?
Rich.
Rich, guru.
That's not how much you invest, it's that you invest.
Yeah. What else would come to mind if you're thinking about Warren Buffett?
He doesn't pay his secretary.
How about the most prolific investor of the 20th century, right? The greatest investor of our time. I don't know many people who've been as successful for as long as he has been. There's people who are, you know, they're good for like 6-7 months and then they're gone. They make a ton of money and then they blow up the firm the next year. Warren Buffett's been around. And what's most critical about this is a value-based strategy, looking at companies with great cash flow, good dividends, low PE ratios, low debt-to-equity ratios. Even Warren Buffett goes through periods of underperformance. Years. What the key differentiator between Warren Buffett and an average investor is, Warren Buffett knows his strategy works in the long term. Even though he goes 2 years underperforming by a 60% margin, he didn't all of a sudden start chasing tech stocks, right? He stuck to his guns. He knows what he knows, and he knows that he has an edge. And that's the most important thing for us as investors, is that we don't switch strategies right in the middle. We have to pick something that has an edge, that's good with our risk tolerance, like you had mentioned, that doesn't have big drawdowns, right? That 17-year period comes sooner for some people than others. But the main thing is, we just can't use our emotions to dictate when to flip and flop, and we can't use performance alone to make our decisions for us. So this becomes important because we're going to take a look at a 10-month interval here. Now, before you guys were investing with John, you probably had 401ks or you did your own investments, right? And you probably filled out percentages of how much to allocate to each type of investment. 25% large cap US, 10% small cap US, 20% US domestic bonds. That's how most people kind of go through the list. They check mark off boxes and they invest. Well, what if after 8 months or 10 months, 8 out of those 10 months, you're underperforming? So you picked a couple of mutual funds, you picked a couple of stocks, and out of those 10 months, you started underperforming. What's your natural inclination?
Change.
Yeah, maybe sell some of the losers, buy the next hot stock, sell international mutual fund, buy US domestic mutual fund. Most people would switch it up. And I think it drives home the point even more that if the benchmark, S&P 500, is up 5.5%, and you're down 1.25%, you're almost underperforming by a 7% margin in that 10 months. That's even more important that we do something to right the ship. If we keep going down this path, we're going to really underperform the Joneses, right? How many people would say that, yeah, you'd probably switch it up after this 10-month period? Right? I see a lot of head shakes in agreement. This performance actually comes out of the Model 3, which most of you are invested in. This Model 3 coming out to the tail end of 07 and going into the beginning part of 2008 underperformed by a very wide margin. Right? Now remember, this asset allocation is 50 bonds, 50 stocks. So our blue line, the benchmark, is our 50 S&P and 50 Barclay bond index. But for a good chunk of time, almost like a year and a half, the benchmark was outperforming this strategy, right? But what the strategy is really telling us is something's amiss in the market, wouldn't you say?
That's killer. So if you look at your statement, what you see is a mission not making as much. But I saw something completely different. When you get the 50 top dividend-paying stocks in S&P 500, they should be outperforming the market. Something's amiss here. Don't know what it is, but that's just not the way things work. The JV team's winning right now, but they shouldn't be winning. That's the example. So human nature does you real well in the jungle. I mean, human nature, if you see a lion, you're run the other direction, right? Man, when you invest your money, you better attack that lion. Because if you invest when people are the scaredest, and you get out and they're the most confident, there's a study that showed how much more success we are investing in that than any other way. So I feel like it's hard to go attack that lion unless you have enough understanding. So yeah, when I look at this model like this, if you were killing during a time period, I can't tell you what's wrong, but something's amiss with the market. The JV team should not be beating the seniors. And so you see what happens, it just crashes down 20-something% there. That's a balanced model. But we stayed in more of a level line. But look at the recovery there. Why do you have such a strong, almost a vertical recovery? The best stocks perform the best in those conditions. But it's difficult because you have to, you look at your statement every day, every month, every quarter. That's all you can see. Now we're not going to talk today about that. We do have a distribution strategy that just puts most of this risk aside. But the pulse that we use is something that the big boys can't use. Warren Buffett can't do that. With as much money he has invested, he cannot go to cash. But I learned a lot from that guy that way. We've been managing money for our clients since last April, right? More than 100 people. And I became very disenchanted because the higher you manage our clients' money, we didn't do well, but I had to be blamed for it. And then I didn't have the feeling that you were doing enough homework. So with enough understanding, I think we can all do significantly better with all the investments that we have. And so it's this is Model 3 is kind of a very bland portfolio, but it's not performed very well. But that pulse we use, you can put that over any indice, and I'm going to show you in a moment the difference it makes, how it helps give you a floor to that downside risk.
Yeah, and I think this is the most critical thing is if you only look at performance, you're looking at your reflection like this. You can't see anything else, right? But if you take a step back and you look at other factors, that's where you can kind of make a better decision about what you're getting yourself into. So this is part of the strategy. This is what the Power Dividend Fund uses to invest, right? This is 50% of that Model 3. One of the edges that we have is equal weighting in stocks. Second edge is we pick only the best dividend-paying stocks. And the third edge is that we have the ability to go to cash when conditions are not correct for the market and then re-enter when the conditions have righted themselves. So let's go through each one of these. What equal weighting means is that when you look at the S&P 500, the S&P 500 is a market cap weighted index. What a market cap weighted index means is that Apple and Exxon are the two largest companies in the world, right? They represent the two top spots in terms of total allocation to the S&P 500. The smaller company you are, in terms of how much your market cap is, the less percentage you're given in the S&P 500. So it offers a little bit of stability, but what it does is that if a company has gone from making computers in their backyard or their basement and grown into the largest computer company in the world, how much growth is really left? It's hard to grow from $800 billion and double in size to 1.6, right? Trillion. That's hard to do. But it's a lot easier to go from 20 million to $40 million company, right?
Yeah.
So what happens is if we use equal weighting, which is the red line, and each company that makes up the S&P 500 is given the exact same percentage of the index, we're not picking different stocks. We're just allowing different allocations. Look how over the last 10 years, how an equal weighted performance gains an edge because the smaller companies that have room to grow have the same impact as Apple or as Exxon, which don't grow as much. So this is the first edge of our strategy, is using equal weight. Are there any questions on this? The second edge is investing in the best paying dividend stocks. So this chart goes from 1950 all the way down here in the lower left to 2010 in the upper right, and if you extrapolate it out, it would be even higher. But this is enough to illustrate the example. The orange line on the top is the S&P 500 with dividends reinvested, and this one is just the S&P 500 on a price appreciation scale alone. So you can see how much more impact dividends have on your total return over time, right? This is not going to be in the next 2 statements. This is going to be over the next 2 or 5 years. You'll start to notice that the dividends will start to play an impact in your total return. Questions on this? And what?
It's a log scale, isn't it?
This is log scale.
Logarithmic scales.
So this difference doesn't look impressive, but it's a log scale. It's a huge margin. I think our company, the W. Donahue Company, did a study from 1871 till now. The S&P 500 total return was like 8.25% compounded annual growth rate. So if you averaged it out over the last 140 years, you would have made about 8.5% every year. If you only took price growth alone, it would have been 4.25%. So almost half of the return that you would have gotten on a yearly basis is comprised of dividend returns. That's why dividends are so important. And you see it playing out from the 1950s even till now. You have something else? Nope. And the final piece is the tactical buy and sell. And this, I think, addresses that 17-year issue, right? 17 years for some people is a lot sooner than 17 years for maybe somebody who's just entering the workforce. What we did is, the red line is just the S&P 500. This blue line here is the best dividend-paying stocks on an equal-weighted basis. And the green line here illustrates when the moving averages start to cross over and the economic conditions start to deteriorate, the power dividend fund goes to cash and you don't have that big drawdown. So say you needed that money 2 years from now because your 17 years is right now. That's when you need the money. That goes to cash. And it just goes sideways until the conditions reemerge. And that is actually, when we showed that slide from the 2007 to 8 period, that is just where we went just flat. As the market came cascading down, even with a 50-50 bond and stock index, that came down about 25%. This one went flat, sideways. These are 3 strategies that help us to achieve better returns overall. So when we look at the big picture, performance is one thing, right? It's a very important piece of the puzzle. You have to have some kind of performance over a given length of time. But another thing that you need to consider is, well, what kind of stocks are you buying? What's your strategy to limit downside risk? What is the current inflationary environment? Are we in an inflating environment or deflationary environment? These are all some of the questions and the data points that we need to gather to really make that good assessment on whether an investment is a good investment and we stick with it, or if it's an investment where we maybe need to choose a different one. But if we use price performance alone, as we showed in the earlier example, we allow emotions to now dictate our decisions instead of more logical, thought out decisions. John?
That's it, you've got to know more to do a better job. And I hear the talk up and down the street and people what they know about stocks. Investing is about more than buying a stock. It's how to buy it, when to buy it, what to buy, when to sell it. All those things are very important. So any of us can pick a great stock. That's, believe me, when you turn the television, hear the radio, you hear about investment, somebody's selling something. On this theory of sevens, there was a State Farm agent that was pushing this. I was told by a client, yeah, State Farm guy said that every 7 years the market crashes, so I should buy an annuity from him. Well, maybe so, maybe not. So we do something unique here with the tactical strategy for sure. And over time, it's going to help us really minimize that downward pain. And I think that if we do a good job educating you, you won't have to bite your bottom lip during bad times. And you can spend your time doing the things that really matter to you a lot more than you might.
Yeah. Did you want to show the Model 3? I have a Model 3 PDF up.
Yeah, I want to show the 4 as well.
The 3 and the 4? I've got both of them up.
Let me ask you, John,
Sure.
how many individual stocks do you own right now? Are you invested in?
Me personally?
No, I mean for your clients.
Well, I got a lot of clients, different models. So different models have different amounts of stock.
You have 3 different models.
There were 6 models.
Oh, 6 models.
6 models, yeah. And you've most of them, all but one of them are going to have some of the 50 top dividend name stocks. Probably the biggest majority of our clients are in a Model 3 balanced portfolio or a Model 4. As you visit me in the next few months, you're probably going to hear me saying, gee, I think we should go to Model 4. And there's a lot of reasons for that, not the least of which is the bond bull market is over now, right? So that's going to be a hard place to win. And I don't want to get my foot out the door. So the Model 4 is very, very attractive to me because half of that is on the 50 dividend name stocks, paying a 4.8% dividend, by the way. One sleeve of it is the top 16 rated stocks in the S&P 500, and then we have a sleeve there of a tactical high yield account. I think it's rather attractive where we are right now. Most of our clients have an annuity. So if you take a look at all your money and we count that annuity as part of your fixed income, if we go to a little more stocks, you're still going to be in a balanced portfolio. We're not, today, new clients are probably not going to hear me make a annuity recommendation just because the market's not right for it. There's tons of companies still selling them, and if all you have one, and you hear some money coming next week, they're probably not going to recommend it because it just doesn't work today. Believe me, the insurance company has a reason to sell that thing, and the guy selling it really has one to sell the thing, but it's just not a good spot right now. I'd rather put more into these, probably Model 4. So you do a good job of showing these. I'm going to try to be quiet.
No, it's everything you say is very worthwhile.
Well, Matthew, I worked real hard to get here, so he knows exactly. This tickles me. I can tell him what I want to show, and buddy, he nails it. So very, very good at doing that. Appreciate you.
Thank you. I've oftentimes heard different market adages or axioms throughout my many years of trading. What I'm about to show you when we flip over to the Model 3s and the Model 4, which is basically a historical analysis of how they would have performed. One of the sayings that sticks with me as a trader is when I was brand new to trading, there was an older gentleman who took me under his wing and basically showed me how to trade. And one of the things that he taught me is he said, Matt, unsuccessful traders focus on how much money they can make on the trade. Successful traders focus on how much they can lose. And I take away from that when we apply it to investing. Right? We're not trading, we're not flipping things out every other day or so. We're taking a longer term approach. But if we focus on the max risk and the max volatility that we can personally endure, then you just set it and you go with it. If your strategy has an edge and you're comfortable with the amount of risk in that strategy, you don't want to be flipping back and forth from different strategies every other month or quarter, right? You have to set it, let it run its course, because over full market cycles, your edge will start to appear in your strategy.
Let me add this. What I had noticed from all of our clients when we first went into business was that And you say, how much risk can you take? To answer that question differently than that is how much can you, when you're making money, how much risk can you take? That number is different than when you're losing money, right? So I got in this business kind of for the back door, helping my mother-in-law, and maybe I didn't come into the conventional way, but I've always been, as you come in, I'm more worried about you losing money than making money. I'll tell you that today. That's my biggest concern. And I was thinking about the other day of, now I have more clients who want to take more risk and be more aggressive, and I can appreciate that. But I was telling my wife, one thing I'm very, very proud of, since the day I went into this business, I never had anybody say, John, you lost my money. And that means a lot to me. Matter of fact, the hair's kind of warm in my head. You see it? As I say that, because it's when you get to any point in life, losing is hard. But it's I guess you'd say I do a lot of things at full speed, but I do tend to be. I maybe err on the side of being a little bit more cautious than I should be. I just look at, you know what? If you make 1 or 2% a year less than we could have made, but you still have plenty. To me, that's a better proposition to say, let's ramp this up to try to make some more money. And then come say, gee, don't worry, it's going to come back. I've never had that conversation with a client, and not to begin to.
Yep, and Model 3, essentially this is a report that we ran through a third-party company, and we just gave them all the data, they ran the report, and what you see is that essentially the blue line, which is us, the Model 3, compared with the correct benchmark, which is 50 bonds, 50 S&P 500, over the long haul, you outperform. And that's because you don't have the big drawdowns during the market crash, right in here. That's how you outperform in the long run. Now, the returns on this, average, right? Average returns, 6.75%. Not super exciting, but if you know where you are on a less risky basis, you can plan around that. 6.75%. John, you said 7% was the sort of the benchmark for your
most
planning?
plans are around 7%.
And the one thing that I think is really important to take away from this is that, does that mean that you get 6.75% every year? Some years it's going to be 20, some years it's going to be down, right? But over the long haul, you'll make about 6.75%. And if we take a look, starting from 2000 up top here, down to 2015 at the bottom, okay, what we notice is, say you came to John and you had this plan, you needed 7% to live, right, to make your retirement work, and you only made 2.33%. Well, John, that's not 7, is it? What would you say?
Well, the way I looked at it, I wasn't in business that year, but the way I looked at it, the market was down 8, we're up 2.3. But dude or dudette didn't see it that way.
You had a client like that, right?
Everybody's got it that way. So, there's two different ways of looking at things. So the market was up 8% that year, is up 2.31. But we're gonna have some presentations later this year. We're gonna do some of our old distributions presentations, which shows you how we get this money to you. So no, I don't worry about that, and an informed client wouldn't. Now the following year, the market went down right at 9%. And this account was up 6.66%. So that looks a lot more attractive. And then in 2002, the market went down 22%. And this was down just a hair. So if that was doing what we wanted that account to do.
And even on the rebound too, market was up, what, 20-something?
Market 26% in 04, it was up 19.81. But do the math on that. You put 100,000 in that 100,000 market, you got a whole lot later. The problem is it's not sexy. It's not exciting. It's going to plod along. And that's what most people say they want. But when you see somebody on TV or your neighbor making a whole lot more money, that's sexier, right? I know it is. That's what's important to understand. We're not the sexy business. Well, you are that, but I'm not.
And I think, one of the important things to take away is we talked about risk, right? So looking at multiple data points to make a more informed decision. Well, this Model 3, if we scroll down here, we're going to take a look at the different risk metrics. Right in here.
Again, we're looking for long-term performance.
So this top line, this is the S&P 500, or 50, I should say, 50 bonds, 50 stocks, right? So the Barclays Aggregate Bond Index is the fixed income side, S&P 500 total return is the stocks. So year to date, through April, the benchmark's up 1.6%. This Model 3 that we're running, down 1/3%. So all of us here that were pre-Speakers Bureau, we might have said, that doesn't add up, does it? Especially if you look out to the trailing 3-year, 9% on the benchmark, 7.2, you're kind of underperforming a little bit on a 3-year basis. But now that we take a look at what's the bigger picture, why do we invest the way we invest? Why do we have the edge of equal weighting, dividend-paying stocks, and tactical strategies? Now we need to take that into account and look at longer-term performance and also the larger strategy. What you see is that the returns kind of normalize. The benchmark is 6 2/3. Our portfolio is 6.8. Right? We go out even further to 15, but this metric doesn't show it. So even at the 10-year interval, you're getting about the same return as the market or the benchmark, the buy and hold people. But here's a key differentiator. Maximum drawdown, or the maximum amount of money you lose off the top, in the benchmark, half bonds, half stocks, down 26% off the top. So if your 17-year period came today and you had $1 million you were counting on retiring with, at some point in time, that was $740,000. That's a $250,000 hit. That's tough to not have emotion come into that and make an emotional decision. But with the balanced portfolio, we can limit it down to 7%. And that's because we have the ability to move into cash and avoid the big drawdowns. So let me ask you, which ones would you rather be in the benchmark? Do you think you're going to be more likely to stay cool-headed losing $250,000? Or would you be a little bit more cool-headed losing just $70,000? And that's, I think, the big picture. So a lot of times, even for myself, if I'm underperforming other colleagues that are traders, sometimes I just, and I don't even like the guy, he's beating me, right? But what I have to really understand is, I have a strategy, I have an edge. That edge isn't always going to work. Las Vegas doesn't win every single hand, but they know if they keep you at the table and they keep liquoring you up, they will win in the long term. And that's kind of the same thing that we're doing, is we're trying to stay at the table as long as possible so that these edges can appear. And it's easier for us to sit with a strategy that doesn't have the big drawdowns off the top. I'll flip it over to the Model 4.
I want people to understand that better. You know what we're saying there? So you buy the benchmark, you have no fee. But if you have $1 million, at some point in time, you have $740. Versus strategy, you're making about the same, but in the worst case scenario, that you go down $740, you're down to $930,000. Is one a lot better than the other two? Yeah. It's a lot better, right? So it's what's happens in our business, in the investment advisory business, and in the brokerage business is they want to turn a deaf ear to your concerns with that. That's the exception with that. Tell them to go pretty long term, not to worry about it. And I thought I never could come to terms with that. That's why I did this way to help minimize that. I've got a little portfolio. Matthew did for me. I said, Matthew, I want a high risk portfolio because I want to be able to feel the stress our clients feel. And we did that, and I put some money into it. And the first 2 weeks, I was down 7 or 8%. I didn't find it bother me.
But I was sweating for my job. I thought I might lose my job.
But the thing is, tore it up this year, right? But the reason is I understand it. I understand how that works. And you just don't have a lot of people that do this because, I don't know why. I just know this. I see you guys every 3 months. And I never want a bad meeting, so I don't want to have to build you up or pump you up. I want you to know enough to where we can have a more meaningful conversation.
Yep, and this is just comparing the Model 3 to the Model 4. So you remember Model 3 had about 6 3/4 average return. Well, the Model 4, we ramp it up a little bit. We put more equity exposure, and we're able to achieve about 3% on average more a year. Doesn't sound sexy?
45% more.
Well, yeah, that 3% doesn't sound sexy, but when you compound that over 15 years, 3% is a huge difference maker in your performance over the long haul. And if you look at just, again, we need to look at all the different risk metrics. Is it this one?
And what you're finding in these reports, these risk metrics, is for the 5-year period, these tactical strategies have underperformed the market. Now that's an astute observation. So let's take a look at it. Why would they? Over the last 5 years, we're in a 6-year bull market, aren't we? Do you need a tactical strategy during a bull market? No. No. Right? You know, it's like driving down the interstate without a brake. As long as there's no bridges out, road closes, police, you're fine. So, you know, in 6 years, and I think that's the most dangerous thing today. I find new clients and older clients alike being more aggressive. I've heard this more this year, want to take more risks, want to take more risks. That's what actually, this tells me something. We've had this many people tell me that, most times I hear, I think we get kind of complacent. We have this 6-year bull market. It may go on another year, 2, 3, or 4 years, but I do know this. It's the 3rd longest bull market ever. I do know this. Clients take it easy and they'll slow down our end, right? So I don't think it's time. We're not going to change our strategy at any point in time. And I will allocate you to a more aggressive strategy. If you tell me to, and I agree, I'll recommend it. But I want you to understand it before we do those things.
Yep, and this Model 4 is really removing a lot more of the fixed income exposure. So in a rising interest rate environment, which is what we're in now, this removes a lot of the securities that would be negatively impacted by rising interest rates, which are bonds, fixed income. But this is 75% stocks, 25% bonds. That's the appropriate benchmark. 1 year, 1 3/4% strategy, down a half. What kind of strategy is that? Trailing 1 year, up 10.5, strategies up 4. Starting to scratch your head, right? But when we take a look back and we look at the bigger picture of what we're investing in.
This is a 5-year period.
Yep, go in there, go in there. All right, so 5-year is still underperforming, but then when you get out to the 10-year, there's this flip, right? So now all of a sudden, the strategy has the edge over just the buy and hold benchmark. But not only that, look at your drawdown of a buy and hold strategy, 40% off the top. A more aggressive strategy, the Model 4, just 11.25. We talked about keeping emotions in check and how sometimes emotions can give us the wrong decision at the wrong time or cause us to make the wrong decision at the wrong time. Is losing $400,000 if you had $1 million account emotional? I'd say so, especially if you're retiring and you're not bringing in a regular income. $110,000, it's not fun, but it's not $400,000. $110,000 is recoverable. And that's the difference in how we create the strategies is we look at things that have long-term edges. Does that mean it's going to be an edge in 2014 and 15? Maybe not. But if you look at 2000 to 2015, there is a definite edge to a strategy. And that's what we pick our strategies off of. Anything else to add to this, John?
I just think, for all of you that are clients, I think it's a great time to be a client. I think it's a great time because I think we're likely something to change some point in time, and I'm not going to be in a position where I say, well, I'm sorry. We're going to be proactive with that. We're going to continue this education, probably not as intense as the first 6 months this year. I want to get enough out there. Matthew, if you read the newsletter, every month we put a lot of newsletters. When we have our quarterly meetings, I'll bring Matthew in on most of those when I think it's more needed and necessary. Going forward, we've got something special I'm trying to do with healthcare for everybody. I need your input to kick Dr. Kay Solar next month. Essentially, what we're looking to do is put together a program for better health and better living. So Kay would just speak to our clients on a monthly basis. She would provide a special meal plan, show you how to meals are healthy for you. Provide activities for some of us to participate and want to. Maybe go bicycle riding, maybe go walking, something of interest like that. So maybe a trip once a quarter, something like that. There's a specialist that I know from the gym that's a soft tissue specialist. If you've got a back problem, he can probably alleviate your pain. So Jade's going to be part of that, and she'll be here the middle part next month. If you know a business owner that's paying more tax than he'd like to pay, and he's successful, my association, Protegra, a third-party administrator, I can do an analysis with their firm to see if there's a way they can save some taxes. Now, that's got to be done between June and September, because it's got to be implemented before the end of the year. And I'm going to ask you, if you would, to take a pen and give me as much information as you can on that board, on that tablet, about what you took away from this meeting. I need to know if this particular meeting met your expectation, if it's what you want more of. Because we put many hours into developing this, okay? And although I enjoy doing it, and I'm sure Matthew enjoyed doing it, if it didn't help you, I'm going to do something else. If you're a guest, I would encourage you to visit with me, even if you have before. We're a different firm than we were 5 years ago. We're a different firm than we were a year ago. And tomorrow we're going to be a different firm yet again, because I don't sit. I'm continually learning to do a better job. Anybody who knows me knows this. I am a big-time worrier. Big-time worrier. I do not worry about your money or my money. And that's not because I'm biting my bottom lip. We've got a process down that I understand, that's repeatable, duplicatable, and I'm very proud to do it, and I'm glad that it is so. So we do have your favorite dessert here today, which is, guess what?
The Greek ice cream.
I like gelato. I've been hearing from the staff, y'all like the
Nothing but cake.
nothing but cakes.
I don't know how many people are new here,
But it's a dual-pronged approach, and it's just one of the different indicators that we use. But it's looking at the earnings of the S&P 500. Let me see if I can pull it up.
Well, he's pulling it up. I'll tell you this, guys. So we look at where the market is today versus 100 days ago. Is it higher or lower? Okay, so let's say it's lower. And then the earnings estimates are also revised down. Then we go to cash.
How long does it take you to go to cash?
Push a button.
Same day.
Same day. So we're not, Danny, we're not.
Same hour?
Yeah, but we're not in that phonetic of a mode either. We look at it once a week on Mondays, okay? So you don't lose, we're not traders, not market traders, it's once a week on Monday. And we watch it, on a regular basis. It's not gonna get you, you're gonna have volatility. You have to have volatility to make some money. So we're not day trading. On the average, it's about once every 3 years. About once every 3 years, the signal will be positive to get out. And use the same methodology as to when to get back in. So we're not going with our stomachs.
Are you pretty much following the same model that Donahue?
No, independent. So that adds an extra layer. It's independent. So when you look at it, I think it's beneficial that we don't do the same strategy as them, because what happens if that strategy for some odd reason has a bad streak? Now you've got both of them doing the same thing, right? Both of them really underperforming. So when you have two different independent strategies that derive entry and exit signals, what it does is it helps to build the strength of the overall system, the robustness. And basically, if one isn't performing as well, then the other one hopefully isn't impacted because it's using a different set of data and variables. So having two independent ones is good. But here's the thing. When you look at the last 15 years, basically all 5 signals were within a week or 2 of each other. So even though we're using different data points and different strategies, we come up with pretty much the same way to get out, the date.
But a common question is reasonable as well. If it works that way, why doesn't everybody do that? Right? Isn't that reasonable? If it worked this well, why wouldn't everybody do that? Well, let's say we're Vanguard's growth fund, right? We have $8 billion in our fund, and me and you are the managers. We meet today and say, Danny, look, these 2 signals this way, we need to go cash. How do we sell it? How do we liquidate it? It'll take us 2 months to liquidate it. If we get buyers to liquidate it at lower prices that are going forward. So we say, look, just buy and hold. We tell our clients what we find long term, and we're probably true. But that's the one single benefit I find in being small. We can sell everything we have, and Wall Street doesn't know about it.
How long has JCN been a broker?
I'm not a broker at all.
I thought we were.
No, I'm an investment advisor. Registered investment advisor.
Okay. So,
Broker's a commission salesperson. Okay?
and who is that?
We don't have one here. I have a advisory license. My broker's license is deactivated and it'll go away here in another year's time. So I had it for number of years, hadn't even used it for a few more. I have no desire to have her one.
Okay.
So everything I do is purely advisory. It's a fee-based thing, so we're
I
not.
thought you had moved into brokering.
No. And it's, you know, to me, it's a bad word. To you, it means the same thing as advisory. But the public doesn't understand what it is. I've got a friend of mine, associate over in Houston, and how clear that is to me. He's a big broker, $2 billion book of business. Now, there's all these wealthy people he sells bonds to, sells municipal bonds to. And I said, why do you do it that way? He goes, no, I can sell the bond and never know what I'm making. So what do you mean? Well, if the bond yields 6, I'll tell them it yields 5, I make 5% commission. I think it's terrible. I think it's rotten. So we're purely advisory. So we're held to a different standard. We're audited by the state of the SEC once a year. I am compelled to provide advice to you and every client in here. So I'm audited different than a broker would be audited. It's a lot more responsibility. But there's no way to do, in my opinion, I cannot do the job the same way I do with a broker's license. You just can't do it. All this get in and out, you can't do that. If I had a broker's license, had you in and out of mutual funds, SEC won't let me put you in this mutual fund today, get you out in 3 months, put back into it in 3 months. So it's very self-serving in my opinion. The way I guess the reason I'm so fired up about this, very self-serving. The public didn't realize it. You told all these great steps, all this great advice, all these people have big bags of money, and they're not ripping you off. But I had a client the other day. His friend was getting ready to invest since his retirement, over $1 million. John, he's had to go to the guy because it's not going to cost him a dime. It's not going to cost him a dime. Who's he investing with? Oh, he's doing this, he's buying this and doing. I said, not a dime. I said, boy, he said, the guy says he ain't paying anything. Look, buddy, he's not writing a check. Without insurance pays that man $80,000 for selling that annuity or that private placement. Whose money do you think you're going to use? You know, I learned from a young age, you don't get something for nothing. It just doesn't happen. So I think that in my end of the business, many advisors like myself don't want to talk to you about fees. They want to put to the table. I never have been that way about it. I felt like, you know what? I'm going to do my best job I can do. Teach you the best I can teach you. And I hope that's good enough for both happy. But if you're not, I'll graciously say goodbye. But I mean, my head doesn't hit the pillow ever worry. My kids work up here. My baby girl lives every summer. I wouldn't want her working up here if I was not treating you the way I tell her to treat people. Now, I get a bit personal with that. This is really a big deal. This is not a business for me. I may be advising you, I've got to pay. You're my friend. I care about you. So I'm going to do what I can, do the best I can. If it's not good enough, I wish I'd done better. But no, I don't have a broker's license. When I have a broker's license, to me it's a nasty word. Here you go. Yes, ma'am.
What is the main thing to learn to be a fiduciary of your own money? What is the main thing we can learn to be a fiduciary of your own money?
Well, I think the best thing anybody can do is save. You people in here, y'all are savers. All right, while you're one, you're savers. That's it. And the best thing to do is learn. You know, if you learn one thing a year, one thing a month, one thing a quarter, you're better off. So I know you all trust me, but I want you to know. I don't want you to have to. If the market goes bad, I don't want Mike and his wife saying, "That's okay. I trust John a lot." I want you to say, "Hey, Jimmy, we're okay, man. John's done this. It'll be cool." See, it's a different feeling for both of us, right? So I'm not going to apologize for it. I do things the way I feel this should be done, and for most people, it works out very, very well.
Maybe I might interject on that one and kind of put in my 2 cents. I've often learned that you earn liberally, you spend conservatively, and you invest mechanically. So the more mechanical and logical you can be, so you earn liberally, right? Make as much as you can make, spend conservatively, so spend less than you make, and with the difference, you invest mechanically. Because if we invest with gut and emotion, we saw how bad that turns out. So if we can stay more mechanical, more mathematical and algorithmic, and just let it go, that's how you get ahead with the investments.
And that's why I built this office. I own this office. I think this portion of the office costs $180,000 land, build everything. And I did it because I wanted to be able to teach you something. You know, I could be seeing new prospective clients say all these other things, but I've got you as clients. So education is very, very, very important. And then execute upon it. All right, so we're going to break now. But I find that people don't really stay committed to a long-term proposition of investing. They tend to want to change and mix it up a lot. And so I asked myself, why do people want to do that so much? And I can only really come to one conclusion. If you're my investment person, and you've got me a long-term investment, that probably does work long-term. But maybe I'm not sure you know what you're doing. Fair enough, right? Yep. Or maybe you don't know what you're doing. So I thought by trying to teach you how we do these things, how we're managing these monies, that you would have a greater level of understanding. And there are a ton of predators out there. A ton of predators. They don't look like predators, but they are. About 2.5 months ago, one of y'all came to my office, and on the way out, he said, well, John, the market's going to crash this year, isn't it? And I said it rather matter-of-factly. So I have no idea. Why do you say that? Well, the guy on the radio said the market crashed every 7 years. And I said, okay, let it go. And probably a week or two later, somebody else came in. John, the market's going to crash this year, 7 years. I said, where'd you hear this? And they said, on the radio. And I said, you know, all I know about investing is there's nothing that's always and forever. And just kind of blew it off. But the third time I heard it, I picked Matthew and got a job for you. I've been hearing these people say this, and if I know anything, I know nothing's every time, nothing's always. I want you to do some homework on me. Let me know that indeed the market crashes every 7 years. And so we looked at that, and then in the process, we looked at one of the things we found very important today. We're trying to help you understand why it's important to invest long term, why it's important to understand it. And I've also realized I haven't done the best job as helping you. Probably the biggest mistake I made, period, was when you come in every 3 months to show you how much you made or how much you lost. That's a bad practice. If you're a long-term investor, but I've got your nose right up against the mirror, what kind of perception do you have? You have to have a longer term. So we're going to take some fun with this today, and I think fun, and kind of show you how these investments work long-term, short-term. How many of you own a business? Business owners. Recently, we've partnered with Integra with defined benefit plans and have really found a way to help a business owner in a big way with a tax plan. 99% profitable business can benefit this way. 1% would, but 99% don't do this. So if you're a business owner, check off the form you have there, somewhere in the form that you want to visit with me. I'll give you a call and kind of tell you what's up on that. If you're a guest here and you've been here before, there's not a better time to visit with us. I would check out if you'd like the consultation because there's so much change taking place. So Matthew is going to go through this presentation.